Google's parent company, Alphabet, just raised $84.75 billion in a single week. Not from loans, not from profits, by selling pieces of itself. And the moment it announced the deal, its own shareholders lost $28 billion in a single day. The stock fell by 4%. Think about that. Google raises the most amount of money any company has ever raised in one go. And the market's reaction is to punish it. So why would raising money cause a stock to fall? That is the question for today. And the answer tells you something important about how the financial system works. So let's start with how selling stocks actually work. When a company raises money by selling stocks, it's not selling something it already owns. It is creating new ownership and selling that. Imagine Alphabet is a pizza cut into 100 slices. You own 5 of those slices. That means you own 5% of the entire company. Now Alphabet bakes 20 more slices and sells them to new investors to raise cash. Suddenly, there are 120 slices in total. Your 5 slices are still yours, but now they represent only 4.2% of the entire pizza. The pizza did not shrink. Your slice count did not change either, but your share of the whole thing got smaller. That is called dilution. Your ownership got watered down, and it is exactly what happened to Alphabet shareholders this week. This is why the stock dropped by 4%. So why is Alphabet doing this? Well, because they are in a race, and the entry fee for staying in this race is hundreds of billions of dollars. It is the AI arms race. In 2026, 4 of the largest tech companies are spending a combined $720 billion building AI infrastructure, data centers, chips, tens of thousands of NVIDIA GPUs at $47,000 each. Massive buildings with servers that run around the clock every single day. Alphabet alone plans to spend $180 to $190 billion this year just on AI infrastructure. The buildings, the machines, the cables, and all the hardware that makes AI actually run in the real world. That kind of spending is called capital expenditure. It is the money that the company puts into things that it will use for years, not just this week. And in 2027, that number is expected to go further. But here's the problem. Even Google doesn't have $190 billion of money just sitting there. Alphabet made roughly $100 billion in profit last year. That is a lot, but it's not enough to fund a $185 billion in infrastructure spending, while also paying out dividends, which are regular cash payments a company needs to pay to its shareholders as a reward for owning the stock, and while also doing share buybacks, which is when a company spends money buying back its own shares from the market to push the price up, plus running day-to-day operations and keeping emergency reserve. All that adds up, and the total is more than what the $100 billion can cover. So they had 3 options: take on debt, cut the AI spending, or sell stock. They chose the third option. Let's take a look into how the deal is structured here. First, $15 billion in regular shares. Alphabet sold new shares in the company directly to public investors in the open market. These are the standard shares everyone can buy through a normal investing app. But here is something most people don't know. There are actually 2 types of Alphabet share, Class A and Class C. The only meaningful difference is the voting rights. Class A gives you 1 vote on company decisions. Class C shares give you 0 votes. Both types were sold in this deal. As a regular investor, this distinction matters because owning more Class C shares means that you own a bigger financial stake, but have less say in how the company is run. Second, $15 billion in something called preferred stock. Here is what it actually means. These are special shares that works like a savings account for a fixed period. They pay you a guaranteed return while you hold them. Then after a set amount of time, they automatically turn into regular shares. Think of them like regular shares with training wheels. You get paid while you wait, and then you are fully in. Third, $40 billion through what is called an at-the-market program. Instead of selling all the remaining shares at once, Alphabet will drip sell them gradually through the rest of 2026. A bit like turning on the tap water instead of tipping a bucket. They sell when the price is strong and pause when it's not. This prevents flooding the market and driving the prices down further. That adds up to $70 billion. The remaining $14.75 billion came from one buyer, Berkshire Hathaway. Berkshire Hathaway is Warren Buffett's investment company, one of the most respected and closely watched investors in the world. Buffett built his reputation by avoiding bets that he did not fully understand, staying patient, and thinking in decades, not months. His company is now led by his successor, Greg Abel, who took over at the start of 2026. Abel's first major move was to put $10 billion directly into Alphabet's AI race in a private deal outside the public markets. So why does this matter? Well, Berkshire spent decades refusing to invest in tech. Warren Buffett stayed out of Silicon Valley for years. His one exception was made in 2016, and it became one of the best investments that Berkshire ever did. The fact that his successor's first big bet is on Google's AI build-out is a signal. It's not proof that the bet will pay off, but it means that the most cautious long-term investor on the planet looked at his deal and decided it was worth backing. Nothing like this has ever been done before at this scale. Well, you might be thinking, I do not own Alphabet shares, so this might not be a problem for me. Well, there's a good chance it is wrong. An index fund is a type of investment that automatically buys tiny pieces of the world's largest companies. When you put money into an index fund, you are not picking individual companies. You are buying a slice of all of them at once. Most pension funds work the same way. Alphabet is one of the largest companies in the world, so it sits inside virtually every major index fund automatically. If you have a pension, even a small one started recently, your pension fund almost certainly holds Alphabet share. That means that this dilution will hit you as well. Your stake got smaller without you doing anything. But there's something bigger here than one dilution event. Look at what's happening across the entire tech sector. Microsoft, Amazon, Google, Meta, spending $710 billion combined this year. Some from profits, some from debt, and some, like Alphabet's $84.75 billion, from selling new shares and diluting existing shareholders. In other words, regular investors like us are part of what is funding the AI race, not by choosing to, but by being just regular shareholders. Whether that turns out to be a brilliant bet or an expensive one depends entirely on whether AI generates the return that these companies are counting on. Right now, nobody knows, but the biggest companies in the world decided the risk of falling behind in AI is greater than the cost of diluting existing shareholders to fund it. They would rather make every existing shareholder a little poorer today than risk losing the AI race tomorrow. So, Alphabet just raised $84.75 billion worth of new shares by creating new pieces of ownership and selling them to investors. Its existing shareholders got diluted. The stock fell by 4%, and $28 billion worth of market value vanished in a single day. This is not a scandal. This is how raising money by selling shares is supposed to work. The company gets the cash, and every existing shareholder owns a slightly smaller piece of the company than they did before. What makes this different is the scale. $180 to $190 billion in infrastructure spending this year. The AI race is being funded in real time. And part of that funding is coming from pension funds and index funds owned by ordinary people like us who may not realize that they were part of the bet. If this was interesting to you, like and subscribe to my channel. Every week, I break down what's actually happening in finance and economics. No jargon, just the story. I'll see you next week.